In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Good afternoon once again, Market Rebels, and welcome back to our second edition of Coach's Corner. If you joined us last week, you know that was our debut. We talked about rights versus obligations, but our goal here is to talk about a different perspective that you're not going to get in other places. We're going to talk about from a professional market makers, such as with Stu, some of our world-class coaches we're going to work into the mix, but it's to really show you more about the hows, the whens, and the whys. And that's super important as we're finding out from today. Stu, where do we close up? Almost 1,200 points, I think?
1,200 points, up $20 on the SPY. I was just telling you, Bill, I don't think I've ever seen that before, 20.
It's been a long time. Yeah. But we had CPI came out this morning. It was 0.5 to 0.8% month over month, I believe was the range. Consensus at about 0.7. They came in at 0.4. Much, much lower than expected. And then we had jobless claims that were 221 to 225, I believe, and they came in at the high end of the range at about 225. But that's actually, interestingly, a good sign.
Everything they were looking for.
Because Powell is looking for cracks in the labor market. So
But you have to understand, how do you structure your positions? How do you hedge, roll, morph? And again, this is what we try to bring you, or what we will be bringing you on Coach's Corner. So for today, our second show here, we're going to bring you what I think is one of my favorite topics, and that is, how much is the option? And Stu, I know you get this a lot too, because everybody thinks, oh, of course, it's the premium, it's the price you pay. But hold that thought. We're going to do a little quiz. I know you're thinking that's not what you signed up for, but it's good news. It's one question. But I do want you to get out a piece of paper, pen, pencil, iPad, anything, and actually commit to an answer. And that's important, because otherwise, when we tell you the answer, people say, oh, yeah, I would have gotten that, right? It's easy to say once you've gotten the answer, but I want you to commit to it.
Just trying to keep you honest.
Just trying to keep you honest. So here is the question. Okay, everybody ready? We're going to come up with some strikes. These are from a pricing model. We've got 0% interest rates, but we've got calls on the left, we have puts on the right, strikes down the center. I'm just going to pick one. So let's pick this guy right here. $10.21. Somebody walks up to you and says, how much is that option? Or how much would you have to pay for that option? And so I want you to think about that for a moment and go ahead and jot down your answer.
Should I write down my answer?
You can write down your answer.
Okay.
Okay, so everybody kind of hearing the Jeopardy music going in the background. I want everybody to think about it. All right, so here we go. What'd you all come up with? Well, chances are, I think some people thought, oh, I know what they're trying to trick us on, is that each option contract controls 100 shares. It's not really $10.21. It's 1,021, because you have to multiply by 100. Or maybe they thought, oh, you got to do that and then add commissions. We get all kinds of answers. So I'm going to throw it over to a professional market maker. Again, for those who don't know, Stu, he was on the Philadelphia floor for 29 years as a market maker.
Yeah, baby.
Arb desk, every kind of trading desk you can imagine.
Yeah.
And remember, what our goal is here with Coach's Corner is to show you a different perspective. We're not here to teach you max gains, losses, break evens of a vertical spread. You can find that stuff anywhere. But we're going to start digging deeper into how to trade options. So I'm going to throw this over to you, Stu.
You know what the real goal here is, Bill? The goal is to keep the folks from making all the stupid mistakes that guys like me made.
Well, that everybody does, right? Yeah. But there's a whole different mentality when you are on a professional trading level versus the retail level. So I'm going to throw this over to you, Stu, and I'm going to ask you, how much was that option?
I'm going to put it up here. Hopefully you'll be in front of the camera. Can you see it?
Ooh, ding, ding, ding. That matches my answer right there. It's exactly what I thought you were going to say. I was hoping you were going to say.
Oh, by the way, it was not rehearsed, everyone.
Yeah, that could have been really embarrassing if you had 1021. But anyway, back to you. Why would you, as a professional market maker, if somebody says the option, which is very obvious, the premium is 1021, why are you saying the option is 21 cents?
Because it's kind of part of what we were talking about last week. It's the right. You're not buying the deliverable. You're not buying the asset. You're not buying the stock. You're buying a right to buy the stock, and you're going to pay a premium to buy the stock. And it's like, what are you not going to pay? You're not going to pay full price. You're not going to have to pay the cash for the underlying asset.
Right.
You're going to have to buy the right to spend the cash for the underlying asset. And that is the premium over and above the cash value of that particular
strike,
distance. You got to look at there's a cash value. Right. I mean, if you have a right to buy something at 90 and the something, whatever the something is, could be a car, could be a piece of ice cream. I mean, whatever it is at $100 on a free market, then
you got to pay the $10 difference.
You got to pay the $10, right? And that's called your intrinsic value. That is not the option. The option is the 21 cents. It's what you're paying for the right
to walk away, or the right to not exercise.
Because if it goes lower, you're done.
Yeah, and I think that's what a lot of people.
Very important concept.
Yep. And a lot of people miss that because they say, oh, but I had to shell out $10.21. But $10 of that was cash. As Stu said, you've got the right to pay 90 for something that's right now worth 100. Right? You could theoretically pay that option, pay the 1021 and exercise it and sell it for 100.
Yeah.
So there's an immediate $10 of cash that can be grabbed from that, and nobody's going to give you that cash for free.
The market is not there to write you a check, believe me.
Correct, for taking no risk. So
the market is there to take your money.
But the question is, what you have to understand, the perspective is, what are you paying over and above cash?
That's
now,
right.
if it's an at the money option, it is the entire premium, or if it's an
100%.
out of the money. But where people get tripped up, especially when their options start going in the money, why they should roll, stock replacement, lots of strategies use intrinsic value, and people mess this up all the time. So let me show you just a couple of diagrams here that can show you the same concept in just a different format. Here's our hockey stick graph. We get our bend at 90, right? We had the 90 strike.
Always
and
have your bends at the strike, guys.
At the strikes, correct, yeah. So if we paid $10.21, that's the maximum we can lose. All right, where's our break even? If you remember where your break even is, it is the strike plus the premium. So 90 plus 1021 is 100.21.
Can I just say one thing here?
Mm-hmm.
This whole idea of break even, some people kind of get lost in the minutia and the noise. Break even means just that. Where are you getting your money out?
Right.
Where does the underlying asset have to be in order for you to get out your, in this case, 1021? That's the number that you're looking for.
Yeah. So if the stock closes at 100.21 at expiration, the option of the $90 call is worth exactly 1021, which is what you paid for it. So that's exactly, if you look at this, let me move this out of the way here. So the break even's 100.21. The stock is at 100. How much are you paying over and above the current stock price?
What we refer to as parity.
Yeah, they usually call it price over parity or something on the floors. Yeah,
Premium
exactly.
Parity. Pop.
So the question is, and Stu, if you can answer this, why would you pay 21? If I can go buy the stock right now for 100, why would I pay an extra 21 cents?
That might be the best question of all time, Bill. And fortunately, we're going to be able to come up with the answer. Ready? Because you get to walk away from it at 90. If the idea turns out to be a stinker and goes the wrong way, I know nobody really likes to think about that side of it, but these things happen. You get to walk away and you're done. The stock owner does not. The stock owner continues to lose, to take it on the chin. You're really buying the right. This is what you don't read in the books, right? You always say, oh, it's the right to buy the stock, right? But what it really is the right to walk away.
Correct.
And that's what you're paying that 21 cents over for.
And that's a really good point, because again, we were talking about perspectives. If people think that the option is just the right to buy the stock, it really misses the point. The power comes from the right to walk away. So you're paying 21 cents for an insurance policy. Now you might think, well, why is the insurance policy so cheap? Well, remember, the stock is at 100, the strike is at 90. So that should tell you intuitively, well, there must either A, not be a lot of time remaining, or not a lot of volatility.
Or it's pretty far in the money, in which case it's 10% in the money. I mean, think about stocks. Are they moving around 10% every day? That's a lot.
Right. It's a lot. And you have to say, what are the chances that this thing actually falls below 90? And if your intuition says not very good, now you'll realize why they are only charging you 21 cents for that premium. Okay, now, of course, what could we do? We could increase the time to expiration, which would give that stock a better chance. We could increase the volatility. And in both of those cases, we would see the 21 cent option go up, but we would not see the $10 of cash move.
That always stays the same. That's always going to be the difference between the stock price and the strike price.
Yep. So here's another way to look at it. Let's say we have two different traders here.
And here's a revelation on that real quick. The strike price is not changing. You're not getting a memo from Mr. OCC that says, oh, by the way, we're going to change your strike price.
Your strike, right.
I mean, every now and then you might get one if you have some sort of a stock split or a takeover or something, but they're going to adjust the option. So that stuff notwithstanding, the strike price is not changing. What is changing is this the strike price is not changing. The stock price is changing. And that is what's going to maneuver that intrinsic value around. The change
Right,
in the stock price.
correct, but that's not what you're paying for the right to walk away. That's just cash. But again, that's where people get tripped up because they think that's the option. It's not. It's just cash. It doesn't count. Okay, at least in terms of the option. Now, here's another way to look at it. Let's say we have two traders. I got trader A over here on the left who buys the stock at 100. Trader B who buys this $90 call for 1021. Let's have the stock fall to 90, right to the strike. What happens to the stock trader? How much did he lose? $10. He's down 10. How much did our call trader lose? He's down 10.21. See, he's only worse off by 21 cents. But people don't see it that way. They go, oh, the stock trader lost 10%, but I lost 100%. I'm never trading those dangerous options again. It's the wrong way to look at it. Both of you lost $10 of intrinsic value. The option trader also bought an option for the right to walk away, who paid an extra 21 cents. So he's only worse off by 21 cents.
Kind of free, isn't it, Bill?
Oh, yeah.
I mean, who wouldn't do that? Hey, you can buy the stock.
21
You can buy the stock for 100, or you can buy the right to buy the stock for 90, but you got to pay an extra 21 cents. Are you in?
Right. And now you're only paying roughly 1/10 the price of the stock. So now you've also got leverage. But just in case you get one of these market downturns, not that we've seen any of those recently, you're really down 21 cents. But too many people look at this and say they're down 100%.
And that throws them off. It throws off their whole psyche.
And that's what we want to talk about here is perceptions. That is the wrong perception.
Absolutely.
Percentages have a place.
This is not one of them.
This is not one of them. So I've got some more questions for you coming up here in a second. But here's one more thing to look at. Here's our risk graph. And the red curve is the current curve, right? The black curve applies at expiration. This happens to be a 100 strike. Now, if the if the stock falls way out here, then it's a deep out of the money option and it's basically worthless. You can just call it junk. If the option goes super deep in the money, now notice how that red line is getting close to the black. That difference between the red and the black is the extrinsic value. It's your option. There's not a big difference. Your
Notice how
option,
either way, the extrinsic value is going AWOL here.
Yep, you're either going to zero or to whatever this difference is between the stock and the exercise. But this area in between is really where the option lies. And the closer it is to the strike, the more it is an option. And that's why people have always wondered, why do you pay the most extrinsic value for an at-the-money option?
There you go.
Well, it's because you have the most uncertainty. It's like a coin flip. Coin going to land heads or tails? I have no earthly idea. 50% is the worst case of, really the truest case of uncertainty. And when you have a stock right there at the money, let's say we got 30 days to expiration, stock's at 100, we've got the 100 calls. Stu, is the option going to be in the money or out of the money?
I have no idea.
50-50. Well, that's why if you have the most uncertainty, you're going to pay the most for the right to walk away. So before we get on to the next part, as always, if you are interested in taking your trading to the next level, tons of free courses and also some coaching sessions, other courses as well. Check out marketrebellion.com/get started. Now, let's take it to the next level here and talk about the call and put connections. Another area where people get tripped up. So here's the same quotes that we saw before, but notice that the call on the left, the 90 strike, is 10.21, but the put is 21 cents. Kind of looks like a little coincidence. The cents portion is the same. We go to the 95 strike, the call is worth 5.97, and the put is worth 97 cents. Again, the cents portion is the same. These are not made up, by the way. These are from a pricing model. The at the money priced the same. But look what happens when we go to the 105 strike. $1.08 for the call, but now the put becomes $6.08. It now has $5 of cash plus the $1.08 over here, giving it a price of $6.08. See, if you don't understand these connections and how these prices change, you are going to be forever lost with strategies. So Stu, why is this happening? Why did we flip over? Why are these cents portions the same? Let me word it that way.
Well, because the 21-cent premium that you're paying for the call is really the amount of money you're buying to not risk the downside.
Right.
And when you get into that 21 cents and the stock goes the wrong way on you, you're out to 21 cents. The put, say that same stock goes to, whatever. What were we saying before? 80,
110.
right? Say if
it falls to 80, yeah.
Yeah, it goes to 80, right? So that 90 call is worth nothing. But what's that 90 put worth? It's going to be a $10 put.
That's a $10 put.
Going to be a $10 put. The difference is going to be the difference is going to be why you're buying that put. But that put becomes the money that you're not losing when the stock goes the wrong way. It's your hedge. It's why we say puts are calls and calls are puts.
Right. We're going to talk about that in a minute too. But the important point is that it's the extrinsic value that is the option. You could either pay 1021 for the right to walk away, or you could buy the stock and an insurance policy for 21 cents for the right to sell.
Yeah.
Or the right to walk away and not sell if the stock goes in your favor. It's just two different ways of looking at the same thing. And this is why we say that calls are puts and puts are calls. So, Stu, again, I know you know this very well from the floor, because this is really one of the key things that floor traders live by. But how to call actually become a put? Sometimes traders think that's weird that we're just saying that like philosophically, but they really do become a put. How is that possible?
Because by buying the call and watching it go to zero, it saves you the money that you would have been losing on the stock. And
Right.
and that value, whatever that value is the price of the put.
Correct.
So they act as the same. The right to buy the stock, the call, what's the hedge against it? Well, the hedge against the right to buy the stock is to sell the stock, right? And when you pair those two together, it actually becomes a put.
A put.
And that's why they have to be the same price. And again, we're not really talking about any cost of carry here, but the extrinsic values are going to match. It's called put call parity. And when you can put these things together, it just becomes a layup about how to go about, maneuvering around adjustments and morphs. And, who wouldn't do that? What's the harm in doing that? Not even talking about the margin. How about the margin, Bill? Do I want to buy the stock for 100 and buy the put for 21 cents, or do I want to buy the call for 1021?
$1,000, yeah. So let's take a little deeper dive into that and see how a call becomes a put. This is a really interesting and important concept to understand your hedges, rolls, and morphs. So let's go back to our two traders. We got the stock at 100. We have trader B over here with the 90 call at 1021. This is what we saw before.
Mm-hmm.
Previously, we had the stock drop to 90, which was exactly the strike.
Yeah.
But now let's have it drop below the strike.
I hate when that.
It's not a good thing. How much does the stock trader lose?
Let's do a quick time out here.
Yeah.
Have we seen a lot of this in the past 6, 7, 8, 9, 10 months?
I think we've seen it more than once.
These stocks just getting destroyed on the downside.
Yep. NVIDIA.
And they're going to keep going. I mean, not that the stock will keep going down, but every time it goes down $1, it's $1. That call, that right that you purchased for some price, that stops going down. Right. It's a hedge. It is a built-in hedge.
It's your insurance policy. That's exactly right. Yeah. So back to this thing, we see that the stock trader has lost $20. How much did the option trader lose? Still loses 1021. This is exactly what Stu was talking about. Once you hit that strike, or the price that you paid,
Bill, how come we can only lose 1021?
Because we have the right to walk away.
You mean it can't go lower than zero?
Nope, that's it. Okay. We're going to say I'm going to exercise my right to not buy the stock. You can look at it that way. So now, but why is there a difference? Why is the 90 call actually better? See, the first time we did this with the stock at 90, the call buyer was 21 cents worse off. But now he's better. So what's happening here? Well, take a look. This is where your call becomes a put.
Follow the money, everyone. Just track the money.
If you had the 90 put, what would that be worth with the stock at 80? It would be worth 10. Mm-hmm. But you didn't get it for free. You had to pay 21 cents.
Yep.
So if you paid 10 for the put and you also paid 21 cents, your gain or your profit is $9.79, and that is exactly the difference between those two prices. You are better off by $9.79. Why? Because your call became a put. It actually insured you against losses.
The 979, people look at it as, what do you mean? What are you talking about? If I buy the call, I'm actually going to make 970. No, it's not that. It's money you're not going to lose.
Correct. You're avoiding
other
losses.
side of the trade.
Yep, other side of the trade. We're going to talk about that in a future class as well, another important topic. But here's one that we've talked about before in Q&A. Let me show you a graphical representation of why calls are puts and puts are calls. So here we've got our risk graph with stock. The zero line shows a break even. But we could also look at this in a different way. We could say that the exercise price is a partition. We're just saying we don't want to accept any losses below the exercise price. And if you look at this little area right there, there's your hockey stick. So this is the current option price, and this area in there is your call option, because notice that we're blocking it off down here at the exercise. We're not allowing for losses.
What?
But if we want to pretend that it's a put, where's your put in here? It's right there. We're just allowing for value to come in between the exercise and the stock. There's your call, there's your put. It's exactly the same graph. It just depends on how you want to look at it. Again, it's back to perspective.
This exercise that you're doing here, Bill, I can't even begin to tell everyone how much this can mean to your understanding of how options work by trying to draw these things yourself and drawing conclusions about what it's going to look like. So and that forces you to have an idea of what your option is going to do as the world around you is changing, as days are going by and stocks are changing price. This visualization of what will happen just becomes completely clear, and it allows you to just move systematically through the adjustment and through the process of trying to evaluate risk and reward.
Absolutely. So remember what I talked about with perspective, and that's really going to be the theme of Coach's Corner. But if a lot of this stuff is new and you're scratching your heads going, I've never seen this anywhere before, you're not going to, because we really try to show people how a professional trader thinks, rolls, hedges, morphs, and the hows and whys behind it. So one last question for you, Stu.
Yeah, man.
We just looked at that $90 call that's trading for $10.21.
Yeah.
Question is, though, if you buy it, isn't this still a negative? Aren't the traders going to face large time decay?
Large time decay. Is this a trick question?
Well, if you're paying $10.21 for the option, right, isn't that going to decay?
You want my answer or you want my funny answer? Like, yeah, there's going to be time decay, but look, you're going to be decaying 21 cents.
Right.
That is your option. Right.
That's the only part that could decay.
It's not going anywhere.
Right.
We're not up against like what's the cost of money 4 years down the road? Let me work in an inflation rate. We're talking about an option that's $10 for a week, 2 weeks, 3 weeks, a month. There's no money in there. It's not decaying. It is always 100% of the time going to be the difference between the stock price and the strike price. Just keep it simple. Don't start putting all this noise into it. The piece that's going to decay 100% of the time, there's not many 100% of the times in the options world, this is one of them, is the amount of premium over parity, the 21 cents. That's it, 21 cents.
Which is another reason why it's important to understand what is the option. We hear so many traders that say, I don't want to do stock replacement. I would never spend $40 or $50 for an option. It's not an option. It might only be 75 cents, but they don't see it that way. So let's take
or it might be $3 or $4 or $5, but
exactly.
It might also be an $80 or $100 or $200 stock.
Right. For a year and a half.
There's a big disconnect between people looking at the idea that they're trading the stock using a vehicle other than the stock to do it.
True.
Right. You got to remember it's a derivative. That might have a bad connotation for some people, but it's not. It just means it gets priced with something else, right? And it really behooves you to kind of know about what those something else's are. I mean, I made all those same mistakes. I thought all the same things as everybody else thought in the beginning, and I had to learn. And what you learn is you learn that the 21 cents is the piece that's going away and it's not the $10.
Because options decay. This is why we're talking about this. But what part is the option?
What part is the option?
It's not 1021. So let's take a look at it graphically. We saw that the at the money option was 285, had 30 days to expiration. So there's your time decay graph. The entire 285 is decaying. Now, I want you to think, for all of our traders out there watching, what does your time decay graph look for the option that was 1021? Or I should say the strike that was 1021. What is that going to look like? People think it's going to be much higher and curve off much sharper, which is why they avoid it. So ready? Drum roll, please. Whoa. There is no decay. It's worth 1021 over here, and it's worth 10 over here. It's flat.
Well, there is 21 cents, but listen, you got to keep it in perspective here.
Right. There's 21 cents. That's why I said the option is worth, the entire call is worth 1021 on the left side.
Yeah.
And it's worth 10 on the right.
Yeah.
So
this is such an important concept. This like, not knowing this keeps people out of an opportunity. And that is so tragic.
Or keeps them into bad ones.
Or keeps them into bad ones. Yeah. Mm-hmm.
Yeah. But this is why we want to teach this to traders. So in the financial world, whenever you have a flat risk graph, that's another way of saying there's no risk. So think about that. How many of you thought that the $90 call was the most expensive option and had the most risk and the most time decay? Doesn't. It's actually the opposite. So these are some of the things that we really want to bring to you on Coach's Corner. One of our favorite expressions we talk about in teaching, famous Chinese proverb, teach me, I'll forget, show me, I'll remember, but involve me and I'll understand. And that's really what we try to do here. And especially if you take any coaching classes, such as with Stu, you can actually sign up with him. But they want to involve you, not just have you memorize stuff. So if it's something that interests you, please check out again, marketrebellion.com/get started. And that's all that we have. Stu, any final comments?
Just that, I, like every one of you guys that are watching, I started somewhere, you started somewhere, Ryan started somewhere, AJ started somewhere, and we all have the same story. Right. And we're all just here to help everybody just to kind of get educated, to learn the language. This is a language. You have to learn the language of risk and reward with respect to options. So you can identify where that risk is and where that reward is. So you can go ahead and you can navigate through the adjustments and the morphs and when do I do this and where am I in with respect to risk versus danger. All these concepts just become quite apparent when you understand what the language is and some of the theory, not all of it, right? The theory can go on forever, but you got to start somewhere. I've been there. We've all been there. But you got to get started just a little bit every day, 10 minutes, 15 minutes, just think about it. That's all you got to do. Just think it through. First order, second order, third order, just kind of think it through. Where am I going? What does it look like? What will the option situation look like? And pretty soon, a lot quicker than you would really think, it starts to come together. Those light bulbs start to, they start to go off. One light bulb comes off faster than the next one and the next one and the next one. And before you know it, it's like
the ball's rolling.
It's just, I can't believe this. Yeah.
So for me, the final closing comments would be, you have to start somewhere. And yes, you might have to say, let me memorize a vertical spread. Let me memorize max gains, losses, and break evens. But that doesn't make you an options trader. People can trade options, but there's a very big difference between those versus options traders. And those are the things that we're going to be bringing to you on Coach's Corner. Stu, what do we have on deck for next week?
Well, I think we talked a little bit about maybe talking about what is the option. Today we talked about how much is the option. Maybe next week we could talk about what is the option. What does it really mean? What is it doing? What is it not doing? What is it?
That's a tough one. So let's do that. We're going to bring Elliot. I think next week we'll have three of us on next week.
If he's around, Mm-hmm.
Yeah, if we can hunt him down. So please join us. Trading Tune-Up Monday 4 p.m. Eastern Time. Cocktail hour for those of you who are actual market rebels. 5 p.m. tomorrow. And other than that, I want to wish everybody a fabulous weekend coming up, and we'll look for you next week. We'll see you then. Thanks so much, Stu.
Yeah, take care.